Happy Friday, everyone. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for February 13th, 2026. If you haven't already, go buy your Valentine something. It's been an unexpectedly good week for mortgage rates. So let's start by taking a look at the numbers. 10-year Treasury yields are lower by nearly 15 basis points, down to just a shade under 4.06%. And mortgage rates are down by almost 9 basis points from where they were last Friday. According to Freddie Mac, mortgage rates are down by only about 2 basis points, but we got to keep in mind that Freddie's number is a weekly average, whereas mine is a point in time snapshot. But the moral of the story is the same. As has characterized the market really since the start of 2026, interest rates continue to extend their gradual decline, a decline that has been gaining momentum as we have progressed through the week. The decline is being bolstered by surprisingly solid labor market and equally surprising cooling in inflation. There were two economic releases in particular that markets were most focused on this week. It was the payrolls report and the consumer price index, or CPI, which is a measure of inflation. On Tuesday, a stronger than expected non-farms payroll report showed that the economy added 130,000 new jobs in January versus an expectation of only about 70,000, and the unemployment rate ticked down from 4.4% to 4.3%. This would typically not be good news for rates, all else being equal. The logic being that recovering labor market is not one that needs urgent additional stimulus, and therefore it would make it tougher for the Fed to justify additional rate cuts. All else, in fact, is not actually equal. So markets defied convention and pushed rates lower. Some market participants called into question the accuracy of the report, and so they kind of dismissed it in light of the delayed release and the partial government shutdown. Others saw the increased odds of a rebounding economy as kind of green light to take some of their worst case recession concerns off the table. Others still are projecting maybe a little bit of a shift in philosophy at the Fed, with Kevin Warsh, who's the president's nominee for Fed chair, at the helm. That philosophy is one where economic expansion is much more compatible with disinflation and therefore additional easing due to expected increases in productivity from things such as AI. Either way, the conclusion was the same: buy mortgages and push rates lower. This morning's inflation report accelerated that rally further. CPI came in at 2.4% year over year, which was below expectations and down a full 0.3% from December. Core CPI, which removes the impacts of more volatile food and energy prices, fell to its lowest reading since April 2021. On top of all that, January home sales showed the largest monthly drop in 4 years. So the combination of cooling inflation, falling treasury yields, and lower housing transaction volumes provided the ideal conditions for an improvement in mortgage rates. And that is what we got, and that's a great way to start the new year. Looking ahead, the things that I'm watching to shape mortgage markets, the direction of the mortgage markets through the late winter and into the critical spring season, are number one, the Fed. Their next meeting is in mid March, and markets are placing basically zero chance of a cut at that meeting, but still pricing in a better than 50% chance that a cut will come in June when the new Fed chair takes over. Economic data is another thing. In particular, data on jobs and inflation will continue to be key, not just as a determinant of what the Fed does, but for how long term rates like mortgage rates will react. Remember, mortgage rates and the Fed funds rate don't always move in the same direction, so data is still important. Uh, Housing affordability is the last thing, and that is that there's a tug of war going on between improving rates and weak housing activity as it relates to affordability. Lower rates are a positive for affordability, but low housing inventory means that prices will likely continue to increase. That is, unless rates can fall far enough to eat into the lock in effect that we spoke about last week. When that happens, we start to progress from a market that is simply stabilizing into one that is normalizing. So keep an eye out for that. That's all I got this week. Hope you guys have a great weekend, and we'll see you next time.